Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange, the heart of global capital markets. I'm Jared Blickery, and traveling with me, as always, is the voice of the people, Sydney Freed. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And now let's welcome back Mark Newton. He is a Fundstrat Global Head of Technical Strategy. Today, we have a master technician, so we are going to look at market technicals. Our phrase of the day is mean reversion. You've heard of the highs and maybe the lows, but today we focus on the juicy middle. And this episode is brought to you by the number 3.25%. That is a jaw-dropping target Mark here has on the 10-year yield. And if you think that's bold, wait until you see Mark's long shot target for the S&P 500. It's eye-watering. Mark, so let's begin here with your big picture overview of the market and just where we stand.
Thank you, Jared. Thank you, Sydney. It's great to be here, first of all. Happy New Year to you and everyone. My target for this year is 6650 for the S&P, which is obviously much less than what we've seen in recent years. We've
About 13%?
Two back-to-back years of 20% plus gains. And so it's rare to see 3 or more years. It certainly has happened in the past, but it is unusual. Markets have started off the year, unfortunately, on a downswing, and that really started during the holidays. We saw fewer and fewer stocks near all-time high territory starting to turn lower. Some broad-based deterioration in groups like financials, industrials, and it's really been thanks to technology that markets have been able to hold up and actually recover. So the market, honestly, is in worse shape if you strip out technology than would be otherwise the case. So, when you look back over the last month, there have actually been 7 sectors that are down more than 5% on an equal-weighted basis, which seems shocking given
out of
the
11,
S&P
yes.
seems, to be still hanging in there and not really showing much deterioration. So, look, the good news is that sentiment has soured in recent weeks while the broader trends really remain intact. And so we do still have a lot of momentum heading into this year, thankfully, given the Magnificent Seven and technology. Therefore, until we see really proper evidence of that changing, it still does make sense to favor large cap growth and really the momentum trade and many of these companies which have made all our lives a lot better in recent years, not to favor mean reversion right away until we see evidence of that really happening to charts until the trends change.
Yeah, and we have a few of the Magnificent Seven rolling over right now, which we can get to in a little bit, but let's just jump into mean reversion, and I'll define it for the viewers. Mean reversion is a tendency for asset prices or other metrics to move back towards their historical average or mean over time. So something that goes too far just comes a little bit back. So just tell us what you're seeing in terms of mean reversion maybe right now or expecting.
There are specifically 2 sectors that are starting to show short-term mean reversion, one being energy and the other being healthcare. Now, this is normal when you finish a year and start a new year. You normally start to see evidence of some of the leaders selling off and also the laggards starting to show some outperformance as you kick into a new year.
There's a seasonality to the ebb and flow of funds, like you have tax flows selling sometimes at the end of one year, and then you see kind of a rush back in January. Is that what you're talking about, or?
That can be partly thought to be the cause. There's some fundamental reasons such as supply shocks with crude oil and reasons why crude is bouncing. Seasonality typically favors, owning energy in the early part of a year. Healthcare, I think, was sold a little bit too hard towards the end of last year, underperformed dramatically on the expectations of, potentially some changes forthcoming in the new administration regarding many of the healthcare companies. But I would argue that, both of these sectors can, in fact, bounce. And, that would be my so-called mean reversion trade. I would caution the listeners and viewers that it's often difficult to put much stock in mean reversion having a lot of longevity. So you can get a bounce in any of these sectors, but normally it tends to be short-lived. As a technical analyst, I want to own things that are showing strength. I want to own things that are at or near highs. We're still in a momentum-driven market. That has not shown proper signs of rolling over just yet, where you really want to be too aggressive in trying to buy things that are out of favor. I know it sounds hip and it's anti-consensus, but it's very, very difficult to make that work in the long run.
To me, mean reversion is sounding a lot like rotation, though. When one sector or stock comes back down, others rise. Is that kind of right?
To some extent, that is correct. And we did see evidence of that last year when technology peaked in July and underperformed for about 4 months while the rest of the market held up remarkably well. That since has changed, and technology now has regained its footing. We're seeing evidence of many of the semiconductor stocks that were hit starting to rally again, some of the software names really showing excellent strength. So yes, mean reversion is something I always try to keep my finger on the pulse of, and I do that with charts that just show sector rotation, how these sectors are doing versus the S&P. When you can see meaningful evidence of longer-term trends starting to give way to the downside or starting to improve, then yes, mean reversion is proper to favor when that happens.
But is it something the average investor needs to pay attention to? Because I think you said it's
Or
kind of
passive,
a temporary,
maybe.
or sorry, passive, because you said it was temporary mean reversion.
Well, with regards to healthcare, look, healthcare has broken almost a decade-long uptrend versus the S&P, which happened the middle part of last year. So to think that any sort of bounce in healthcare means that this sector should be overrated for the year, I think is dubious at best. I do not subscribe to that. Yes, investors should pay attention to what's happening under the hood versus just looking at your average ETF that might be chock full of many large cap technology names that don't necessarily always fit into an investor's portfolio. And so, looking at equal-weighted indices, equal-weighted sectors, how that rotation is starting is very important.
Really interesting to think that mean reversion is almost like looking for a top or a bottom, while its complement, or maybe an opposite or an inverse, is momentum, and you're just kind of trying to ride the surge, and you're not necessarily trying to find that top or bottom, you're trying to participate in that move. I would ask you, does that resonate with you? And then what do you see in terms of the bond market? Because we've been seeing a lot of strength in rates in the dollar. Any reversion to the mean in the cards for you in 2025 there?
So mean reversion, let's say you're at the top of a flight of marble stairs and you putt a golf ball down the stairs, and then you're hoping that the ball will stop before it hits the bottom and turn higher. Oftentimes that's how successful mean reversion investing can be.
I love that analogy.
Without any proof of change of trend. I oftentimes wait till I have at least some evidence, and we saw that in China last year. We saw proper evidence that China was bottoming and started to turn up. That was an evidence where, enough was in place to say, okay, they're going to start to implement stimulus, and technically China started to act much better and started to turn higher. So yes, that was one specific evidence when it did work. With regards to the bond market, this entire year has gotten kicked off thinking that not only the economic data has been stronger than anticipated, but also we're entering a new regime where, potentially policies might lead to more inflation on the horizon and tariffs in particular. I would argue that's gotten to be a little bit too cute and too consensus, and that oftentimes when everybody's saying the one thing, that's why bond yields are rising because Trump's definitely going to be inflationary, then it pays to consider what other things are happening or that actually could be wrong. I specifically do not view 10-year yields to immediately get over 5% this year. I'm expecting that yields are very close to peaking out. So we take evidence of more issuance for treasuries. That's certainly important. The new incoming Treasury Secretary plans to extend the maturity of how they're going to issue some of the longer term treasuries. Those are definitely reasons why treasury yields could go higher. However, the economy is certainly not perfect, and we do see evidence of hiring slowing down dramatically, ever so slight signs of unemployment ticking up. So the hiring, has largely, ground to a standstill, whereas jobs are open, but we don't necessarily see the hiring picking up. So it's really interesting when you look at the underlying dynamics that largely stem from COVID. I think eventually that's going to be ironed out and we're going to get a little bit more of a real picture. Even most economists are puzzled as to why, we can see the situation we're seeing in the labor market. And also with regards to housing, we see a massive, move in recent years and home prices higher, and all of a sudden mortgages are 7%, largely unaffordable to the broader population. So those two things are going to be, I think, an issue heading into this year when thinking, well, the economy's on great footing and yields can go to 6% and do it slowly and everything will be fine. I am a market bull this year. I do think equities go higher, but I don't think it's going to be a straight shot higher. I think it's going to be a difficult run. And I think that treasury yields do have a shot of pulling back. It gels with a lot of my longer term cycles. on Treasury yields that says they honestly go down into next year, and we potentially could get down to 3.25, which might seem shocking to some that are saying, well,
jaw dropping. That's our number sponsor of the day, and we'll get to that.
Right.
I want to ask you. We got a few more minutes left before our break. I want to ask you about the AI trade. Well, let's talk about the Mag 7 because we were talking about concentration. I mentioned a few of those stocks are rolling over. Like Nvidia had a nasty reaction after that CES speech by Jensen Huang. It just had the worst day in 4 months, and that's after it broke to new high. Then I'm seeing similar things in Alphabet and Meta. Any of that concerning for you?
It's not concerning only because it's short-term in nature, and the recent deterioration has not broken any of the intermediate-term uptrends for any of these stocks. So while it might be shocking to say, a stock has moved to the most to the downside it's done in many months, technically the stock is still in excellent shape, and it's very, very difficult to extrapolate that a short-term move like that means definitely that we're going to start to move lower. So you have to trust these stocks that are at or near highs until they give you ample proof that they're rolling over. I don't think we've seen that in recent weeks.
All right. Do you have something?
I was going to ask in terms of the Trump trade, what signs are you looking for in the markets that we're going to see some breakouts there?
Well, we have seen breakouts that happen.
More breakouts.
More momentum. What you want to see is more momentum.
I want to know when crypto is going to 100 or Bitcoin is going to 150,000. No, I'm not asking you that. But what are you looking for in terms of the Trump trade?
Well, we've seen evidence of both financials and consumer discretionary start to, as I would say, reignite in heading into the election as Trump's lead started to grow versus Harris. Promises of deregulation, tax-friendly policies. We'll see if any of this comes to fruition. We know that obviously there's a flip side to all this positivity, and that the tariffs could throw an ugly, wrench into the picture. But that didn't happen in 2016 to 2019. So we really have to, sort of wait until we see proper evidence before thinking that anything could cause that so-called mean reversion down that everybody's expecting when the new administration takes over. I happen to trust a lot of the moves that I've seen in some of these sectors, and I think it's very promising. Yeah. What could change things? If yields go over 5% on the 10-year, I think that would be something that would change things dramatically. If we start to see high yield junk bond deterioration, that would also be important and a negative. If we see consumer staples starting to rear its head up, meaning the defensive trade is coming back, these things have not happened. So these are things that make me still pretty optimistic for the year. But yet again, it's another year we enter with all sorts of things to worry about. We'll see if any of these
We just need something to talk about for the next few weeks, and we're doing that, by the way. We got to take a quick break here. Coming up, we are going to be talking about S&P 500 targets as well as the 10-year target for 2025. And you're going to want to bring your poker face to today's Who Wore It Better. This episode is brought to you by the number 3.25%. That's where Mark here sees the 10-year T-note yield heading down this year, and it would be a pretty big drop. And I believe it's been referred to as jaw-dropping before. So it's 4.7% now, almost 1.5 percentage points away from that. And that would be a huge tailwind for risk markets like stocks if that happens. But I want to highlight too something interesting that's happening in the market. The 10-year yield has now surged 1 full percentage point or 100 basis points higher since the Fed started cutting short-term rates. So short-term rates are 100 basis points lower because that's where the Fed is directly taking them. And then as a reaction, the 10-year has shot up 100 basis points. And as Torsten Slok, chief economist of our parent company, Apollo Global Management, has said, this hasn't happened before. The closest analog that we could find since the 1980s is 1998. Really interesting there, Mark. I mean, what do you think of this?
I agree it's unusual. I think that I heard it happen shortly after 1981 that could have been as extreme, but I think that this is a different dynamic. It's going to be an interesting new regime. We shall see if the so-called tariffs lead to massive amounts of inflation. I think a lot of things have sort of spooked the bond market, as we spoke about earlier. Some of those have been that economic growth has actually been better than expected in recent months. That's caused rates to go higher at a time when the Fed clearly had a very hawkish cut in mid-December, which caused many of the different rate cuts to be taken out of the curve. And so you have to sort of scratch your head and wonder if the Fed was right in that. The Fed, I mean, various
to cut
voting
100 basis
members
points.
for that dot plot to shift so dramatically when we really haven't seen proper evidence that would justify people thinking that policy is absolutely going to be inflationary. So I wonder if that's going to come out in the minutes, and we'll see. My thinking is that the economy likely is not as strong to have yields immediately go over 5%, and I think we will see the so-called mean reversion in Treasury yields that will take things back lower in the months to come.
Wait, people seem worried about bond yields going to 5%, but isn't that like good for investors? Don't they want to see a 5% return like that?
It certainly can be very good if it happens slowly. I would argue that it's more about seeing bond yields go up based on growth, not based on inflation worries. That's a big difference.
Interesting.
So it's not the level per se of yields, it's more the velocity. And when yields move up very, very sharply on things that are deemed inflationary, simply based on recent data with the ISM, for example, that came out much hotter than expected, and that specifically also coincided with inflation rearing its ugly head back during 2020 and 2021. So that's something a lot of people watch very carefully. As to whether that has legs or not, we shall see. I just argue that the move has come too far too quickly. Sentiment seems to have gotten very negative on treasuries, and everybody's talking about this being the new consensus. I oftentimes want to bet against that. I'm willing to take a mean reversion trade back to the upside for treasuries, thinking yields are going to roll over, when it seems to be a little bit too consensus to me that yields have to go higher.
What about any other consensus trades? So we went through your bond market prediction. Actually, let's go over to your stock market prediction. Let's see if I can get your targets here. You got 6650, I believe, is your base case. That would be a 13.1% return. And then 7300 is your bull case. That's a 24% return.
That's right.
That would be a third year of 20% plus returns. But 6650, what do you think gets us there, and what gets us 7300?
What can get us there is simply a broad-based recovery in many of the sectors that have slouched a bit in recent months. So we have seen some underperformance since the election in groups like industrials and financials and discretionary. Many of the groups that led last year started early in backing off. That is the so-called normal mean reversion trade that can happen many years as the year comes to a close. Many of these sectors are still technically and fundamentally in very good shape. Industrials tend to do better as the Fed's cutting plan comes underway. We've seen big breakouts to new all-time highs in the Dow Jones Transportation Average, and I think that's very encouraging as we start into a new year. So how can that get there? I think if yields start to roll over, that's going to give some life into the small and mid-cap trade again, which has really been lacking, right? A lot of these small-cap companies, they have to borrow money, and it's very difficult to do so as yields are rising, and some of the companies are losing money as well. So that makes it difficult. I would argue as yields pull back, the dollar pulls back, that's going to give some life to small and mid-caps, which will fuel, regional banks, biotechnology, and honestly can help many different sectors begin a more broad-based rally. So that's how we get to 6650. Above that, my maximum is right near 7350. It sounds like a moonshot, and it likely is for this year. But the most realistic target is going to be right near 7,000 if 6650 is exceeded. And so that would be a real Goldilocks scenario where the Fed, potentially can put a couple more cuts back into the curve. The market's okay with that. The bond yields don't immediately go sky high. They start to roll over again. And growth continues. We see good earnings, and we see the economy honestly in good footing. And if we make any sort of effort, and if we can succeed in trying to cut the spending, that's also a big deal that a lot of people really have not touched on. But that's one of the reasons also why bond yields have been moving higher, is the sense that now we don't have a balance of power, and we're going to continue to sort of spend in reckless fashion, and so yields could go higher. I would argue, I think we're going to see the opposite of that. So I'm hopeful that we can see sort of a balanced economy this year, and a good period of earnings and growth, and that technical trends will, continue to impress like they have in recent years.
You're hopeful, but what's the bear case? What are the risks here?
Well, the risk is that China's sort of deflationary tendencies, could metastasize to the U.S., and we've seen their bond yields drop down to the lowest on record. They're down to about 300 basis points under U.S. Treasuries.
That's pretty shocking right there.
That's a huge move, and many are wondering whether they're going to become Japan and the deflationary times of the early 90s. And so, I think they need a lot more stimulus to really help their economy to go. They have a lot of issues, obviously, as we all know, with regards to more commercial real estate and just trying to get the economy jump-started. And so I'm not, that's my sort of, bear case, is that China's deflation actually will spread to the US, which could be a good thing. It'll actually keep our inflation a lot lower than it would be ordinarily. Also, if we start to see, we haven't seen any evidence of junk yields or reasons why we could see dislocation in the bond market, and that's really key.
The debt of private companies who would have a junk status is not trading that much far above the risk-free yield, which is U.S. Treasuries. In other words, that spread is historically pretty narrow.
There's a couple things that almost always happen before we go into a bear market, and one is that we get a very loud and clear warning sign from the bond market. We have not seen that yet. Mm-hmm. Junk yields have been historically, very tight as compared to treasuries. The other is that we start to see more and more stocks falling from 52-week highs and really starting to roll over. That happened back in 2021. That's the one thing I would encourage investors to look at. Look at the percentage of stocks above their 200-day moving averages. Look at the percentage of stocks within 20% of their 12-month highs. Mm-hmm. When that starts to nosedive under 50%, and you only have one sector like technology leading the way, then that can be problematic towards an underlying period of bearish rotation getting underway that could lead to a larger correction that many investors simply aren't paying attention to because they're looking at QQQ and their NVIDIA is going to new highs every day and everything's great. Meanwhile, other stocks aren't acting as well. So those are at least two things that I'm looking for that could be warning signs. I don't necessarily expect them to definitely happen this year, but if they do towards mid-year, I'll certainly wake up and smell the coffee and try to help investors recognize that.
All right. We got to get to today's Who Wore It Better, and today we are dealing the cards, and we're taking a page from Mark's favorite game, which is poker. So we have two classic strategies going head to head, starting down the runway today as we pit the value bet versus the bluff. The value bet is all about playing strong, playing the odds when you've got a strong edge. Think long-term investments in undervalued assets, for instance, like treasuries, maybe financials. On the other side, the bluff, this is a risky move. It's speculating on the next big thing, like maybe chasing disruption stocks or placing moonshot bets on the S&P itself. So Mark, which strategy is wearing this 2025 market better as we sit here in early January? Are we stacking our chips on the value play or the bluff play?
Honestly, I would look at the Mag 7 as not being any type of bluff. I would think that you have four of a kind there that likely are going to win any hand. I mean, you have NVIDIA, you have Apple, you have Meta platforms, and you likely have Microsoft. You could expand that to 7, but we don't play 7 cards except when we're playing stud.
Not in this.
So I respect the fact that value has been trounced in the last decade because large cap growth has outperformed. Value certainly has come back on the small cap side and also on the mid cap side. It's really been only on the large cap, and as we know, growth continues to outperform. So, I would certainly look to, 3-bet and go all in with the Mag 7 versus anybody's attempt to try to challenge me with any sort of value type, what I deem to be a bluff, because value just right now is almost like a 7-deuce offsuit. It's very much out of favor.
Mark, you have a poker face. Let me just say that right now. And guess what? We're out of time. We have wound things down here at Stocks in Translation, so make sure you to check out all our other episodes on the Yahoo Finance site and app, as well as all your favorite podcast platforms. Be sure to leave a comment, and subscribe wherever you get those podcasts.